Hey everyone, and welcome back to the Violet Vault. You know, we're always talking about making your money work for you, right? About finding smart investments and building passive income. Well, what if I told you that one of the biggest expenses in your life, your car, could actually start paying you? Yeah, you heard that right. Today, we are going to pull back the curtain on how your electric vehicle can go from being a money pit to a money-making machine. Seriously, this is a total game changer, so let's jump right in.
I mean, really stop and think about that for a second. That shiny, high-tech car of yours, what's it doing right now? For most of us, it's just sitting there, parked. For like 95% of its life, it's idle. But inside that car is this incredibly valuable, powerful battery, and we're just letting it sit there, doing nothing. Well, that's all about to change.
So I want you to completely change the way you think about your car. This is way bigger than just getting from point A to point B. This is about discovering a secret side hustle that's been hiding in plain sight, right in your own garage. Okay, this slide breaks it down perfectly. On the left, you've got the old way of thinking. A car is an expense, plain and simple. You pay for the car, you pay for the insurance, and with an EV, you pay to charge it. Your money only flows one way, out. But now, look at the right side. This is the new way. Your car is now an asset. It literally pays you to be parked. Instead of losing value while it's sitting still, it's actually generating income. This is what we're calling a kinetic battery. You know, to really get this, let's make it real. Let's imagine two people, we'll call them Dave and Sarah. They both live here in the US, they both own electric cars, they could even be neighbors. But what they do with their cars is a world apart, and it's going to make this whole idea crystal clear. So Dave does what most people do. He comes home, he plugs his car in, he pays the electricity bill at the end of the month. It's just another expense. But Sarah, well, Sarah's car is a kinetic battery. It's an active part of her financial plan, and every single Friday she gets a little payment, a dividend, from her car. So the big question is, how on earth is she doing that?
All right, so what's Sarah's secret weapon? The technology is called bidirectional charging, but don't worry about the jargon. Honestly, the easiest way to think about it is this. Her car is basically an energy trader. And what's the number one rule of any kind of trading? It's simple, right? Buy low, sell high.
Here's how it works, day in and day out, all on autopilot. Step 1. In the middle of the night, maybe around 2 a.m. when everyone's asleep and demand for power is super low, the price of electricity plummets. Your smart charger knows this, and it automatically starts filling up your car's battery with that dirt cheap energy. Step 2. Your car just holds onto it. It's like a little energy piggy bank. Then, step 3 is where the magic happens. Think about 4 or 5 p.m. Everyone's getting home from work, they're turning on the lights, blasting the AC, starting dinner, power demand goes through the roof, and the price of electricity skyrockets. Well, that's the moment your car automatically sells a little bit of that cheap energy it's stored back to the grid, and you pocket the difference. It's a classic case of arbitrage.
Now, there are a couple of powerful ways you can use this. The first is called vehicle to home, or V2H. Think of this as your personal energy independence. Let's say a big thunderstorm knocks out the power on your block. While your neighbors are scrambling for flashlights, your car quietly kicks in and powers your entire house. The lights, the TV, the refrigerator, everything. It's literally your own personal silent backup power plant. Plus, you can use it to just power your home during those expensive peak hours, saving a ton of money.
The second way, and this is where the real side hustle income comes from, is called vehicle to grid, or V2G. With V2G, you're not just helping yourself, you're actually becoming a small part of the power grid. You're selling your car's stored energy back to the utility company to help them keep the lights on for everyone during those super high demand times. And because you're providing a valuable service, you get paid for it. This is where the real passive income opportunity kicks in.
Okay, I know. This all sounds fantastic, but I can hear you thinking it. That's cool, but show me the money, right? Let's get down to brass tacks. What can you actually expect to save and earn with this? Let's start with just the savings. If you only use the vehicle to home feature, just charging at night and using that cheap power to run your house during the day, studies have shown that a typical US homeowner can save anywhere from $1,000 to $2,500 a year. That's real money that just stays in your bank account instead of going to the utility company.
But hold on, because this is where it gets really wild. If you get into some of the more advanced vehicle-to-grid programs, where you're actively helping to balance the grid, the potential annual income in some markets here in the US can be as high as $9,000. Let that sink in. Your car sitting in the driveway could earn you more than a lot of part-time jobs. That's insane.
And look, I want to be clear, this isn't some far-off futuristic dream. It is happening right now. For instance, there's an automotive engineer named Zhao Yu who's been doing this. He tops off his battery at home with cheap power, then sells a little bit back while he's parked at work during peak hours. Just doing that, he's making about $70 a month. It's a real-life working side hustle.
So you're probably wondering, okay, if this is so great, why isn't every EV owner doing it? And that's a fantastic question. The reason you're hearing about this now is because a really important door just got kicked wide open for regular people like us, especially here in the United States.
See, for as long as any of us can remember, the energy market has been a one-way street. It was an exclusive club, open only to giant power companies. You and I, we were just customers. We were allowed to buy power, but selling it back? No way. That was off limits. But that all changed with this. I know, it sounds super boring, FERC Order 2222. But trust me, this is the key that unlocks everything. In simple terms, this federal rule basically told the big grid operators, you have to let the little guys play too. It created a path for individual resources like your car's battery to be bundled together and compete right alongside those massive power plants. This order is the reason this is no longer a what-if scenario. It's the reason you can do this right now.
All right, I'm a realist, and I know a lot of you are thinking, this sounds a little too good to be true. So, let's have a reality check. What's the catch? Let's talk about the two biggest concerns that everybody brings up.
This is always question number one, and it's a good one. You spend a lot of money on your car, and the battery is the most expensive part. So if I'm constantly charging it and discharging it, am I just going to burn it out? It's a completely fair thing to worry about.
And the answer, thanks to some really smart tech, is no, not if it's managed correctly. You see, the research from top-tier institutions is pretty clear. These new systems are designed to be incredibly gentle. They use small, shallow charging and discharging cycles, and they keep your battery in that healthy, happy zone, between about 20% and 80%. They never drain it dry or max it out. In fact, one major 5-year pilot program found no significant extra wear and tear on the batteries at all. These systems are built first and foremost to protect your car.
All right, concern number 2 is the price tag. This isn't just a software update. You do need some special equipment to make this all happen, so what's it going to cost to get set up?
So the big ticket item is the bidirectional charger and the hardware that goes with it. Fully installed, you're typically looking at a cost somewhere between $5,000 and $15,000. And yeah, I know, that's a serious chunk of change. But here's the other side of that coin. First, there's a federal tax credit, 30C, that can immediately shave $1,000 off that cost. And second, when you start doing the math on the thousands you can save and earn each year, the payback period, your return on investment, is usually just 3 to 7 years. So yes, it's an investment, but it's an investment that pays for itself and then some.
So let's just boil this all down. If you walk away with anything today, I want it to be these 4 things. 1. Your car is not just a car. It is a powerful mobile battery. 2. The strategy couldn't be simpler. It's just buy low, sell high. 3. The timing is perfect. Thanks to new US rules, the market is finally open to you. And 4, the risks are manageable. The technology is smart enough to protect your battery, and the investment pays for itself.
When you put it all together, what we're really talking about is a fundamental shift. You have the chance to take what is normally one of the fastest depreciating assets you can own and completely flip the script. You can turn it into an active, working asset that generates passive income for you and your family. That is incredibly powerful.
So this really leaves us with a fascinating question to think about. After hearing all this, how do you see it? The next time you walk out to your driveway and look at your car, what do you see? Is it just an expense, a machine that costs you money? Or do you now see the potential for it to be a powerful financial asset? I would genuinely love to hear your thoughts, so drop a comment below. I read every single one. Thanks, as always, for hanging out with me here at the Violet Vault. Keep making smart moves with your money, and I'll see you in the next one.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome to the Violet Vault. Today, we're diving deep into a corner of the investment world that most people have no idea even exists. Imagine for a second, what if you could invest in a lawsuit, the same way you invest in a stock or a piece of real estate? Well, you can. It's a multi-billion-dollar industry called litigation finance, where justice itself becomes an asset. It sounds wild, I know, but we're going to pull back the curtain and see exactly how it works.
All right, let's kick things off with our first section, the lawsuit marketplace. To get our heads around this whole idea, we've got to start with one really simple but kind of mind-bending question.
Just think about that for a second. Yeah, you heard me right. Not investing in Apple or Amazon, but investing in the outcome of a legal battle between two parties. It's this one question that spawned an entire industry. And while it might sound a little bit like something out of a sci-fi movie, it actually solves a very, very real-world problem for everyday people.
Let's make this real. Picture a bike messenger, maybe in downtown Chicago, weaving through traffic. A car runs a red light and hits him. He's got a broken leg, he can't work. His lawyer says he has an open and shut case against the driver's insurance company, but that could take 2, maybe 3 years to settle. In the meantime, rent is due next week and medical bills are piling up. He needs money right now. What does he do? This is the exact gap, the exact problem that litigation finance was created to fill. It's a financial lifeline when the wheels of justice are turning really, really slowly.
Okay, so we get the problem. We see why our bike messenger needs help. Now, let's get into the what. What exactly is this solution, and how does it actually work? In plain English, it's basically like Shark Tank for lawsuits. An outside investor, a third party who has absolutely nothing to do with the case, steps in and gives our bike messenger cash up front. In exchange, if and only if he wins his case, the investor gets their original investment back, plus a nice chunk of the final settlement. It's a simple deal on the surface, but what happens if he loses? Well, that's where the secret sauce comes in.
This right here is the absolute game changer. The funding is non-recourse. Now that's just a fancy legal term, but what it means for our bike messenger is simple. If his lawyer loses the case, he owes the investor absolutely nothing. Zip, nada. He keeps the money they gave him, and the investor just loses their entire investment. This is what makes it so different from a loan. It's not debt. It's a high-stakes bet, more like a venture capital investment in the outcome of the lawsuit itself. All the risk is on the investor.
Now you might be thinking, this all sounds a little shady. And you're not wrong to think that. For hundreds of years, this was actually illegal. In medieval England, they had laws with these amazing names like chumperty, which basically meant you couldn't profit off someone else's lawsuit. The idea was to stop rich guys from funding bogus legal attacks against their rivals. But fast forward to modern times, and the thinking is totally flipped. Especially here in the US, courts started to say, wait a minute, maybe this isn't meddling, maybe this is actually a way to give people access to justice they couldn't otherwise afford. And with that change in mindset, the floodgates opened.
Okay, so if you're an investor and there's a very real chance you could lose every single penny you put in, why on earth would you ever do this? Well, the answer is simple. Because when you win, you can win big. The potential upside is just astronomical.
Just take a look at these numbers. Fund managers in this space are targeting an internal rate of return. That's basically the yearly profit they aim for on their investments of 20 to 35%. To put that in perspective, the historical average return for the S&P 500 is around 10%. We're talking about returns that potentially double or even triple what you'd expect from the stock market. You can see why this gets the attention of some very big, very sophisticated investors.
But the massive returns are only half the story. Here's the real holy grail for big-time portfolio managers. These returns are uncorrelated. That means they have absolutely nothing to do with what the stock market is doing. Think about the 2008 financial crisis. The market was crashing, real estate was in a free fall, but the outcome of some patent lawsuit in Texas? It didn't care. It was completely independent. For an investor, having an asset in your portfolio that zigs when everything else zags, well, that's priceless.
And this chart just lays it all out, clear as day. Look at the target returns for what they call third-party litigation funding, or TPLF. That's the tall bar on the left. Now compare that to private equity and the S&P 500. I mean, it's not even in the same ballpark. We are talking about a totally different level of potential profit.
Okay, but it can't all be sunshine and roses. Those huge returns come with two absolutely massive risks. The first one is called binary risk. Binary just means 1 or 0. It's all or nothing. You either win and get a huge payout, or you lose and your investment goes to 0. There is no second place. The other big one is duration risk. Time is the enemy of returns here. A case that pays out $1 million in 2 years is a fantastic investment. But that same $1 million payout after 5 years of waiting, it's a much, much worse investment. The longer it takes, the more your annual returns get watered down.
So, all this talk about profit and returns leads us right into the heart of the matter, where things get complicated. Because anytime you start mixing massive amounts of money with the justice system, you're going to have a really intense ethical debate.
So, the main argument for litigation finance is a powerful one. It's all about access to justice. It's about leveling the playing field. It gives our bike messenger the financial firepower to take on a giant insurance company that could otherwise just bury him in legal fees. The argument is that without this kind of funding, thousands of perfectly valid cases would never even make it to court.
But then you see a story like this one out of Kentucky, and you see the dark side. In the part of the industry that deals with individual consumers, some funders have been accused of acting like modern-day loan sharks. In this real-world case, a person got a $30,000 advance on their settlement, but because of the crazy high interest rates, by the time the case was over, they owed the funder over $340,000. I mean, that's an effective annual interest rate of almost 80%. It raises some really serious questions about whether this is helping people or preying on them.
And this chart really gets to the core of the problem. Think of a lawsuit settlement as a big pizza. This analysis shows that when a litigation funder gets involved, the slice of the pizza that goes to all the legal costs, including the funder's cut, gets a lot bigger. And the biggest worry is that the slice left for the plaintiff, the actual person who was injured in the first place, can end up being smaller than it would have been without the funding. So the question becomes, is this just moving money from the victim to the investors and the law firms?
All right, so just when you thought this couldn't get any wilder, let's talk about the future. What happens when you take this already controversial, high-stakes industry and you smash it together with one of the most disruptive technologies out there, the blockchain? Well, you get something that could change absolutely everything.
You'd probably heard of an IPO, an initial public offering, where companies sell stock to the public for the first time. Well, get ready for the ILO, the initial litigation offering. The vision here is huge and honestly kind of crazy. They want to create a public marketplace, like a stock market, but for lawsuits, where literally anyone can buy a tiny financial stake in a legal case. So here's how it would work. A big legal case needs money. The platform takes that case and basically chops up the financial claim into thousands of little digital tokens. Then you or I could go online and buy some of those tokens, maybe for as little as $100. We'd be directly investing in the case. Then, if the case wins, a smart contract, which is just a piece of code that runs automatically, distributes the profits to all the token holders' digital wallets. No middlemen, no waiting. It's a radical idea to democratize this entire asset class. All right, that was a lot to take in. We've gone from medieval England to the blockchain, all in the pursuit of understanding this hidden financial world. So let's zoom out and boil it all down to the key things you really need to remember from all this. First, just know that this is a huge, multi-billion-dollar asset class that's quietly operating all around us. Its biggest selling point? The potential for massive returns that don't care one bit about what the stock market is doing. But, and this is a huge but, that potential comes with the very real risk of losing every single dollar you invest. And this creates a fundamental tension, a deep ethical question about whether we should be profiting from the justice system at all. And finally, as if all that wasn't enough, this whole industry is being supercharged by new tech like the blockchain, which could change the game completely.
And so that really leaves us with the final big picture question. Is turning lawsuits into an investable asset a brilliant financial innovation that gives the little guy a fighting chance? Or is it a moral hazard that risks turning our justice system into just another casino for the rich? I'm honestly not sure there's an easy answer, but I would love to know what you think. Let me know down in the comments. Is this a smart move or a dangerous game? Thanks so much for watching, and I'll see you in the next one.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.